Tech stocks have surged this year, but can they keep that momentum in 2021? Or are we setting ourselves up for a crash? In this video, I'll show you how to find the tech stocks that still have room to run, then reveal the 5 that nobody is talking about. We're talking top tech stocks to buy in 2021 today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, this is one of my favorite videos of the entire year. We've already covered dividend stocks and penny stocks in our 2021 portfolio, but tech has been where it's at for the returns this year. In fact, last year's tech stocks that we recommended on the channel are up an average of 67%, with shares of Logitech surging 119%. That's outperforming the broader market by 50% and even beating this year's gains of 44% in the tech sector. But to do that again, we're going to need to dig in and find the few undervalued, undiscovered tech stocks with gas still left in the tank. The sector just had its third highest annual returns in 2 decades and 4 times the average return of 9% over that period. The market is undeniably expensive. Those of you in the Bowtie Nation are going to recognize this chart. It shows research by FactSet on the market PE ratio, now at 30 times earnings. The green dashes here are the 5-year average. The blue dashes, the average market PE over the last decade. Nation, the market is trading 67% more expensively than it has on average over the last 10 years. And tech stocks themselves are trading for over 35 times on that PE basis. Now the reality is though, stocks don't fall just because they get expensive. You have to have a catalyst for that correction or the crash, so high prices don't necessarily mean we can't keep booking those returns. But you need to know how to find those tech stocks that are going to keep on going. In this video, I'll share my rules for finding good stocks in an already expensive market. We'll look at some of the criteria that you can use to screen for those stocks. Then I'll reveal the 7 tech stocks to watch for double-digit returns in 2021. I'll be putting this video inside our playlist on the channel, the best stocks to buy for next year, along with all those other 2021 picks, so make sure you check out that entire portfolio. As a special bonus, if you're not using the Webull app yet to invest, click through the link that I'll leave in the description below and you'll get 4 free stocks when you make your first deposit. It's free money, helps support this channel, so I appreciate it, and it's gonna be an instant return on your portfolio. Now, I've been using Webull for over a year now and love the stock simulator that lets me test out different ideas and strategies before investing. So look for that link in the video description below and check that out. Now before we get started though, I wanted to throw this out to the community. Do you think tech can outperform again in 2021 like it did this year? And what stocks are you watching and what do you think should be added to our list? So just scroll down, let us know in the comments, can tech do it again next year? I know you want to get to those 7 tech stocks, but I want to share my criteria here for finding these, keys that are going to help you find other stocks for your portfolio. And Nation, when the market is so expensive like this, you have got to use something more to find your stocks than just what you hear on YouTube or online. It's these criteria that are going to help you find those stocks that are going to keep running higher even if the market slows down. And first here, I'm going to be using some kind of a GARP framework. Now that's growth at a reasonable price, a way of finding growth stocks that even though they might be more expensive compared to the rest of the market, they're still relatively cheap considering growth and their other fundamentals. Now here, one of the best ratios you can use is the PE to growth ratio. That's the normal price to earnings ratio that you're probably familiar with, but then divided by the growth rate of earnings. Now I'm going to show you an example and tell you what this does. But you just take the price of the shares divided by the last 4 quarters earnings. That's that traditional PE ratio that you know, and shows you how much an investor is paying for every dollar of profits. Then you take this number and divide it by the annual growth of earnings, but as a whole number. So if the company is growing earnings by maybe 20% a year, then you would take that PE ratio divided by 20. For example, if we look at shares of Apple at $125 each, and then earnings over the last 3 quarters of $3.26 per share, that's a 38 times on a traditional PE basis. Now that's really expensive considering Apple traded for as low as 15 times earnings just last year. But we see the company is growing earnings at 14.4% a year. That's this year's earnings through Q3 divided by the $2.22 per share in the previous period. And you can get these numbers from Yahoo Finance or any investing platform. Now I took the 3 quarters of each year for the most recent comparison, but you can also take the recent 4 quarters of earnings over the previous 4 quarters as well. So if we take that 38 PE ratio and divide it by 14.4, we get a price to earnings to growth ratio of 2.6 times. Now what you do with this, and this is something you have to do when you're talking about any kind of financial ratio, whether it be price to earnings ratio or the margins or anything, is you have to compare that with the stock's own history. Where has it traded on that ratio in the past, and how does that stack up against other stocks in the same industry? That's what's going to tell you if these shares are relatively cheap, even considering the growth, or if maybe they're getting a little expensive right now. Now, why I like this PE to growth ratio so much for tech stocks is it's going to give those companies credit for that faster earnings growth. It just puts everything in better perspective compared to that traditional PE measure. From here, I'm also looking at companies that can continue to trade on that growth rather than a valuation or some other fundamentals. Because Nation, if this year has shown us anything, it's that expensive stocks can just keep on going, keep posting those huge returns if investors feel that future growth is still there. When you find these high growth focused companies, that expensive PE ratio doesn't just mean as much because investor sentiment can continue to take that price higher. So here I'm looking for companies that continue to increase that revenue every single year, preferably at a faster pace each year. I'm also looking for companies that are using a little bit of spending discipline to drive that higher profitability and that earnings are growing at a faster pace than sales. So not only do I want to find companies with faster sales growth, but also that are leveraging better profitability to make more money. For this, you can look at the operating margin. So what percentage of a company's sales are left over after paying those operating expenses on that income statement? Now that's the company's core profitability measure and really my favorite ratio to measure. Because Nation, if you can find companies growing their revenue and getting more profitable at the same time, it doesn't matter how expensive the shares are, they're just going to keep running higher. Okay, now on for the main event. For this, I used that same criteria to find 7 tech stocks to buy for 2021, and I also tried narrowing the list here to maybe a little bit more undiscovered or unloved stocks. I don't want to just dump a bunch of the same tech picks that you're going to hear on every other channel like Tesla or Apple. Zoom Info Technologies, ticker ZI, is a cloud-based intelligence platform for sales and marketing teams. The company just issued shares this year and has a great niche in helping companies optimize their sales numbers. And as an entrepreneur, I can tell you that use of data analytics in marketing is hugely needed, and few do it as well as Zoom Info. The company booked 107% sales growth last year and even managed to expand on that by another 48% this year. Operating income did slip a little bit as the company ramps up for that growth, but it's still expected to post 32 cents a share earnings this year. That would give it a lofty price of 128 times earnings, but factor in that 48% earnings growth, and the PE to growth ratio is a much more reasonable 2.7 times. Analysts have price targets here from $50 on the low end to $60 a share over the next year, so even that low target is 22% above the current price. The pandemic has not slowed CACI International, ticker CACI, a provider of IT and tech solutions to governments and the defense industry. For the company, it's really the cybersecurity segment that's coming through, and 90% of the revenue is from repeating contracts. Now, this company has built a $22 billion backlog of orders, which is nearly 4 years worth of revenue, so lots of runway for growth here. And surprisingly, on earnings of $13.62 a share here, the PE ratio isn't even that high at 17.6 times, so this one doesn't even look that expensive on that traditional measure. Add in that earnings growth, though, of 36%, and the shares are just 0.48 times on that PE to growth measure. Analysts have price targets as high as $315 per share, with an average target just under $282 each over the next year. Splunk, ticker SPLK, offers data management and IT services for corporate clients, and its cloud service is really developing into a leadership in the space. Now, for a legacy provider, Splunk has done a great job of redeveloping its service, kind of redefining itself around the cloud, and it's showing through in growth. Revenue grew by 31% last year and earnings by 41%, though it is taking a hit this year. Shares trade for 84 times normalized earnings, but I think it can get back to that 30 or 40% earnings growth quickly, which means that its PE to growth ratio is somewhere around 2.5 times. Analyst targets range from a low of 160 a share to as high as 275 each over the next year, and an average that's 33% over the current price. TU Incorporated, ticker TWOU, is a $2.5 billion provider of tech services for colleges and universities. Its main service here is developing those online platforms for delivering education over the internet, which is a pretty good model to be in right now. The company works with more than 75 universities to offer 475 plus programs, and I don't think this model is going away anytime soon, not even after COVID. We're in a decade-long shift to digital delivery, and that's going to benefit companies like 2U. Revenue grew at a 40% annual pace in the 2 years to 2019 and has just accelerated since then. The company did report an earnings loss of $1.09 in the last 4 quarters, which is expected to narrow to a loss of just 60 cents next year. Analyst price targets are from $34 a share to as high as $55 each over the next year, with a 31% upside to that average target. NetApp, ticker NTAP, is one of the older companies on the list, but still booking solid growth and paying a 3.2% dividend yield. NetApp has done well in its transition to those cloud services and is developing its AI and analytics solutions for future growth. Revenue growth has slowed a little bit this year, but is expected to rebound to that longer-term trend around 4% annually, which I think the company can turn that into earnings growth of 10 to 15% range. Shares trade for a 14.7 times on that traditional PE basis, which, like we saw with CACI, isn't that high to begin with, but then factor in that earnings growth and it's just 1.5 times on that PE to growth metric. The average analyst target here is right around the current price, though they run as high as $70 a share. Now, I think you can book strong double-digit returns here, including that dividend over the next year or two. Vera Mobility, ticker VRRM, is a $2.2 billion transportation software provider for government and commercial services. Vera is at the center of that push to data intelligence in smart transportation, one of the biggest trends as we evolve into 5G and IoT capabilities. Sales grew by 22% in 2019, and the operating income surged tenfold, which led it to surprise on the upside to positive earnings for the year. The pandemic has slowed business a little, and earnings fell to just 4 cents a share this year after that 21 cents last year. Now, earnings are expected to recover fast, though, with 24 cents per share next year, and this could be one of those game-changer stocks that really surprises over the next few years. Now, as with a lot of the stocks on the list, it doesn't really help to measure that traditional PE ratio on this year's earnings, just because how this year has played out. Earnings are just so out of whack. On a more normal 24 cents per share earnings, though, the shares are trading at around 56 times on that traditional PE basis. Now, even assuming growth of just 20%, though, the PE to growth ratio is just 2.8 times. Now, just 2 price targets here from analysts, so don't read too much into this, but price targets ranging from $13 on the low end to as high as $15 a share on the high end. Now, I think this one easily goes to that $18 a share next year and even higher after that. Considering the business model, Yelp, ticker YELP, has done incredibly well this year, with shares down just 8%. Yelp is a user-generated reviews platform for local businesses with 96 million monthly users and over 500,000 local businesses advertising on the app. And with local dining representing 60% of the views and 15% of the ad revenue, it's no surprise here that revenue has slipped, but it's only down 10% on the year. Before this year, Yelp had annualized revenue growth of 9% and reported earnings of 52 cents per share. The company is expected to post earnings of 15 cents a share next year before doubling it to 39 cents a share in 2022. It's got a strong advantage in that business model for that user-generated content and should book higher sales as its services platform grows as well. So on that, shares would be an unimaginable 204 times that 2021 earnings, but then just 10.2 times on the PE to growth ratio, and that's on a modest 20% growth, which I think it can average over the next several years. Analysts aren't quite sold on Yelp, though, with a price target as low as $19 a share to as high as $37 each, which would still only be about a 15% upside from here. I think there's a lot more to like here on that recovery play, and I like the company's expected growth. Click on the video to the right for the 5 best stocks to buy next year. 5 stocks from any sector that could turn your portfolio into a money machine. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.